The Little Book of Common Sense Investing by John C. Bogle. Picture this. There's a family called the Gottrocks. Over generations, they have grown into this massive clan with thousands of relatives spread across the country. And here's the kicker. Together, they own every single publicly traded company in America. The whole thing. 100%. Every year, it's like Christmas. They collect all the profits, all the dividends, every bit of growth that American business generates. And since they all own it together, they all get richer at exactly the same pace. It's beautiful, really. A winner's game if there ever was one. But then, things get interesting. Some smooth-talking outsiders show up. We'll call them the helpers. These helpers are charming, persuasive. They pull aside a few of the sharper Gottrocks cousins and whisper something tempting. Why settle for average when you could crush it? We'll help you pick the winning stocks and dump the losers. You'll leave your relatives in the dust. The cousins bite. They start trading stocks back and forth, and the helpers take a little commission each time. Here's where things get weird. The family's total wealth starts growing slower than before. Why? Because now a slice of their pie is going to the helpers. What was once 100% theirs is now just a little bit less. The smart cousins panic. Their brilliant plan backfired. So they double down and hire professional money managers, more helpers, who promise expert stock picking for a fee. A year passes, and guess what? The family's wealth grows even slower. Their slice of the pie shrinks further, because these new managers are constantly trading, piling up commissions and triggering massive tax bills. Now the cousins are desperate. They bring in a third wave of helpers, consultants and financial planners, to help them pick the right managers, who will then pick the right stocks. These new experts promise, just pay us our fee and everything will work out. And with that, the family's share of the pie takes another nosedive. Finally, the whole Gottrocks clan gathers for an emergency meeting. They turn to their wisest old uncle and ask, how did we go from owning 100% of the American pie to barely 60%? The old uncle sighs and says, all that money you paid to the helpers, all those commissions, fees, and extra taxes, it came straight out of our earnings. There's only one way to fix this. Fire them all, he says. The brokers, the managers, the consultants, every last one. Go back to what we did in the beginning. Own all of American business, and then just hold it. Do nothing. Then, the uncle concludes, we'll get back to keeping 100% of the pie that corporate America bakes for us, year after year. That elegant little story? That's the key to everything we're about to dive into. It's the heart of a book that quietly sparked a revolution in finance, The Little Book of Common Sense Investing by the legendary John C. Bogle. Bogle wasn't just some author. He founded the Vanguard Group and created the world's first index fund. He spent his entire career fighting for the little guy, for families like the Gottrocks, for people like you and me. In this slim volume, he reveals a secret so simple, so powerful, that the entire financial industry has spent billions trying to convince you it doesn't work. Today, I'm going to share that secret with you. By the time we're done, you'll understand the single most reliable way to build wealth over a lifetime. It's a method that's not just simple, it's mathematically guaranteed to beat most of the professionals at their own game. So let's jump in. Let's learn how to claim our fair share of the pie. To really grasp Bogle's wisdom, we need to understand that when people talk about the stock market, there are actually two completely different games happening at once. The first is what he calls the real market. This is where actual businesses operate. Companies making real products, selling real services, and when they do it well, earning real profits and paying real dividends to shareholders. This is the world of enterprise, innovation, and long-term value creation. Over the last century, American businesses have delivered returns, averaging about 9.5% per year. This is a winner's game. Because of economic growth and productivity, the pie keeps getting bigger. Capitalism, at its core, creates wealth. But then there's the second game. Bogle calls it the expectations market. This is what you see on financial TV, with ticker symbols flashing and pundits shouting. Here, prices aren't determined by fundamentals like profits or sales. In the short term, prices are driven by emotion, speculation, and what investors think other investors will do next. It's a giant, chaotic casino. And this is where things go sideways. The fundamental truth Bogle says is this: over the long haul, stock market returns must equal the returns of the actual businesses. The real market always wins eventually. The emotional, speculative noise of the expectations market just cancels itself out over time. Look at a 100-year chart and you'll see two lines. One shows the actual investment return, dividends and earnings growth of corporations. It's remarkably steady, sloping upward. The other line is the market return, the wild, jagged roller coaster of stock prices. It zigs and zags, shooting up in bubbles of greed and crashing down in valleys of fear. But over decades, it's like there's a magnet pulling it back to that steady business line. It always returns to reality. So if the secret to wealth is just owning businesses and letting them grow, why do so many people lose money? This brings us to Bogle's most powerful idea, the relentless rules of humble arithmetic. It starts with something almost comically obvious. As a group, all investors in the stock market are the stock market. Therefore, all investors together must earn the market's return. Before subtracting costs, investing is a zero-sum game. For every person who beats the average, someone else must underperform by exactly the same amount. It's like poker. Money just moves from one player's stack to another's. The total on the table doesn't change. But in real life, investing isn't free. Remember the helpers from the Gotrock story? In reality, these are brokers, money managers, and financial advisors. They're the casino dealers. And like any casino, the house always takes its cut. This cut comes as fees, commissions, and operating expenses. Once you subtract these costs, the simple arithmetic becomes brutal. After costs, beating the stock market isn't a zero-sum game anymore. It becomes a loser's game. Think about it. As a group, we all start with the market's return, let's say 8%. Then we all pay our costs. The average mutual fund, Bogle shows, has total costs around 2.5% to 3% per year. That money doesn't come from thin air. It comes directly from your returns. So that 8% market return instantly becomes 5.5% or 5% for the average investor. In a single year, this might not seem devastating. But here's where Bogle introduces the dark side of compounding. We love talking about the magic of compound returns. We forget about the tyranny of compounding costs. Let's run a quick experiment. Say you invest $10,000 at age 20 and leave it for 50 years. If the market delivers 8% annually, and you could capture that entire return with zero costs, your 10 grand would balloon to a staggering $469,000. That's the magic. Now let's be the average investor in an actively managed mutual fund. Same 8% market return, but subtract that 2.5% in costs, leaving 5.5% net. Where does that same $10,000 end up after 50 years? Just $145,400. Let that sink in. The market baked a pie worth $469,000. You, the investor who put up all the capital and took all the risk, got only $145,000. The financial system, the helpers who risked nothing, walked away with the other $324,000. They took almost 70% of your potential return. As Bogle puts it with grim irony, we get precisely what we don't pay for, so if we pay nothing, we get everything. This is the core problem. But it gets worse. Bogle discovered what he calls the grand illusion. The returns that mutual funds report to the public aren't the returns that actual investors in those funds earn. The reality is far grimmer. How? Two very human, very costly mistakes: bad timing and bad fund selection. Fund companies spend fortunes on marketing, always promoting their hottest recent performers. Human nature kicks in. We see a fund that's rocketed up 50% in a year and think, I need in on that. So what do? We pour money into funds after spectacular runs. usually right near a bubble's peak. When those same high-risk funds inevitably crash, we panic and sell near the bottom. We buy high, sell low. The exact opposite of what works. Bogle shows the data, and it's brutal. During the dot-com bubble of the late 90s, investors poured hundreds of billions into aggressive tech funds just before they collapsed. Afterward, the funds themselves reported mediocre but positive returns over the full cycle. But the average investor in those funds, devastating losses. Many lost more than half their money. They chased past performance right off a cliff. Add up the penalty for costs, and the penalty for bad timing and selection, and the numbers become heartbreaking. Over a 25-year period where the stock market itself delivered solid returns, Bogle's research shows the average mutual fund investor ended up with real, after-inflation profits that were just 22% of what they could have earned by simply owning the market and doing nothing. So if picking winning stocks is a loser's game, and picking winning fund managers is a loser's game, what should we do? This is where most people get stuck. They think, okay, I can't do it myself, so I'll hire an expert financial advisor to pick funds for me. The professional helpers, right? But Bogle presents sobering evidence. Study after study shows that funds recommended by brokers and advisors perform even worse than funds investors pick themselves. They tend to have higher fees, higher sales charges, and they chase the same hot trends everyone else does. He tells the story of two new economy funds launched by a major brokerage in March 2000, right at the bubble's peak. The firm's brokers sold $2 billion of these funds to clients. Within 2 years, one fund lost 86% before shutting down. The other was down 79%, a marketing triumph for the firm, complete catastrophe for their clients. So now the picture's complete. We've tried picking stocks. We've tried picking funds based on past performance. We've tried hiring experts to pick funds for us. At every turn, we've been crushed by the relentless rules of humble arithmetic. We're left searching for a tiny needle of a winning fund in a massive haystack of losers. And this brings us to Bogle's breathtakingly simple, revolutionary solution, his twist on the old saying, "Don't look for the needle in the haystack, just buy the haystack." What does that mean? Buy the entire stock market, all of it, every company, big and small. How? With his invention, the classic all-market index fund. An index fund is simplicity incarnate. It doesn't have a star manager trying to outsmart everyone. No team of analysts hunting for hidden gems. It doesn't trade constantly, racking up costs. It does one thing, buys and holds a portfolio mirroring the entire market. If a company represents 3% of the U.S. stock market's value, the index fund holds 3% in that company's stock. It's pure ownership, not speculation. You're casting your lot with the real market of business and completely ignoring the noisy expectations market. And here's why this is mathematically guaranteed to work. By owning the entire market, you're guaranteed to receive the market's full return, whatever it is. You've eliminated the risk of picking the wrong stock, wrong industry, or wrong manager. The only risk left is market risk itself, which nobody can escape. But here's the key. Because index funds don't have all those layers of helpers, costs are microscopic. The best index funds charge as little as 0.1%, or even less annually, compared to 2.5% or 3% for actively managed funds. Back to our humble arithmetic. All investors together earn the market return minus costs. Active investors as a group pay high costs. Therefore, as a group, they must underperform the market. Index fund investors pay almost nothing. Therefore, index fund investors must outperform the average active investor. This isn't theory, it's not opinion, it's mathematical certainty. Over the 35 years Bogle studied, of the 355 equity funds that existed at the start, only 3, less than 1%, managed to both survive and consistently beat the market index. The odds are terrible. By simply buying the haystack, the index fund, you'd beat 99% of professionals without lifting a finger. This principle isn't just true for big stocks in the S&P 500. It works for mid-sized companies, small companies, international stocks, even bonds. The logic is universal. In any market, the average return is the market's return. Costs separate winners from losers. Since index funds have the lowest costs, they almost always win. But recently, Wall Street's tried to corrupt this beautiful, simple idea. They've created complicated new products and tried passing them off as the next evolution of indexing. First came new paradigms, or fundamental indexing. These strategies claim to have found a better way to build an index, weighting companies by dividends or sales instead of market value. And surprise, when they backtest their data, their new method always beat the classic index in the past. Bogle warns us to be skeptical. This is active management in disguise, another claim that, this time, it's different. He reminds us that investing has seen countless new paradigms over the years. The go-go funds of the 60s, the Nifty 50 of the 70s, the new economy funds of the 90s. They all had their moment in the sun, then faded away. The market tends to revert to the mean. What worked spectacularly in the past often works terribly in the future. But the biggest threat to his simple idea, Bogle says, is the exchange-traded fund, or ETF. An ETF is like a mutual fund you can trade all day like a stock. It's a wolf in sheep's clothing. The original index fund was built on long-term investing philosophy, buy and hold forever. The ETF encourages the opposite, short-term speculation. While you can buy an ETF tracking the whole market, Wall Street's created hundreds letting you bet on tiny market slices, the energy sector, a single country, even soybean prices. This, Bogle argues, betrays the entire principle of indexing. It tempts investors to abandon broad diversification and make concentrated bets. It encourages market timing, jumping in and out of hot sectors, the very behavior that's proven so destructive for mutual fund investors. He compares the ETF to a beautiful, finely crafted shotgun. It's great for big game hunting in Africa, he says, but it's also excellent for suicide. For most investors, the constant temptation to trade ETFs will be, if not financial suicide, at least severely wealth-depleting. So where does this leave us? After a lifetime of research, fighting battles for small investors, Bogle's advice boils down to something beautifully simple: a plan for your serious money, the money you depend on for your future, retirement, and family security. He suggests a simple rule for asset allocation. Hold a percentage in a safe, high-quality bond index fund roughly equal to your age. If you're 20, maybe 20% in bonds. If you're 70, 70%. The rest goes into a single, ultra-low-cost, all-market stock index fund. That's it. Buy it and hold it. Stay the course. Ignore the noise, the headlines, the hot tips from your brother-in-law. Stop obsessing over the market and let the quiet, powerful force of compound returns do its work over your lifetime. It may not be exciting. It's probably boring. But as Benjamin Graham, Warren Buffett's mentor and the father of value investing, once said, "To achieve satisfactory investment results is easier than most people realize. To achieve superior results is harder than it looks." The classic index fund makes achieving those satisfactory and ultimately superior results unbelievably simple. It's the only strategy that ensures you'll be a winner. As we wrap up our journey through Bogle's little book, it's worth considering why such a simple message feels revolutionary. In a world constantly telling us success requires complexity, that wealth rewards being smarter, faster, and more clever than everyone else, Bogle's message is almost rebellious. He's telling us the secret to winning the investment game isn't playing it better than anyone else. It's refusing to play their game at all. The real power of Bogle's idea isn't just the undeniable math, it's the freedom it gives you, freedom from pretending you can predict the future. Freedom from constantly checking your portfolio, wondering if you picked the right stock or manager. Freedom from that nagging feeling someone, somewhere, knows something you don't. What Bogle offers is a path to quiet confidence. The confidence that comes from knowing you've harnessed the full power of the American economy while paying almost nothing for the privilege. The confidence that while others frantically trade, pay enormous fees, and make emotional mistakes, you're patiently, quietly, inexorably building wealth. So how can you put this wisdom into practice starting today? First, have an honest conversation with yourself about your investments. Look at the fees you're paying. The technical term is expense ratio, and you can find it for any mutual fund you own. If you're paying anywhere close to 1% or more, you're fighting an uphill battle you're almost certain to lose long term. The relentless rules of humble arithmetic are working against you. Second, embrace simplicity. Next time you feel tempted to invest in a hot new sector or a fund with flashy recent performance, remember these lessons. Remember the dot-com investors who piled in at the top. Remember that reversion to the mean is one of finance's most powerful forces. Yesterday's star is rarely tomorrow's star. Finally, if you're just starting your investment journey, consider making a classic, low-cost, all-market index fund your very first investment. Whether it's the S&P 500 or a total stock market index fund, you'll be starting your financial life on a foundation of pure common sense. You'll be buying the haystack, guaranteeing yourself your fair share of all the growth and innovation our economy produces for decades to come. That was a deep dive into the core ideas of the Little Book of Common Sense Investing by John Bogle. We've explored the essential lessons, but I have to be honest, a summary can only ever be a map. The real treasure comes when you make the journey yourself. The magic happens in those quiet reading moments when a story or phrase connects with you unexpectedly. This overview helps you decide if this book deserves your time. If anything we've discussed has struck a chord, I truly encourage you to grab a copy. Reading it isn't just about learning. It's an experience that can fundamentally change how you think about money and your future. The link to the book is right in the description. Also, if you found this summary valuable and it brought you clarity, please click that like button and subscribe to the channel. That way, you won't miss our next exploration of another life-changing book from the Billionaire's Bookshelf. Let's keep growing and learning together.